Now, a lot of the problems that created the speculative derivative problems that created what happened in 2008, well, they haven't gone away. They've just been papered over and they're just floating out there. But as you can see from this graph from the Office of the Comptroller of the Currency that tracks derivatives in the FDIC insured U.S. bank deposits or depositories, the level of derivatives are much higher today than they were in 2007, 2008. And much of it is still kind of similar to the derivatives that were created before that. As long as you keep paying the fees, they don't have to settle. However, banks generate a huge chunk of their revenue by trading these derivative contracts with your deposits, even though you don't know it because you don't see it. Doesn't matter. Insured U.S. commercial banks and savings associations reported trading revenue of $12.7 billion in the third quarter of 2022. That is $2.4 billion more, or 22.9%. So they love this volatility because it enables them to make a whole lot more money and also maybe some losses, but almost 23% greater than the previous quarter, or 84.1% higher than a year earlier. That's significant, don't you think? Because I sure do. I mean, they made 84.1% more than a year earlier. That's crazy. And this is all based on the derivatives in the FDIC insured banks. So there's far more that are speculative than our end user. This is your trading revenue right up here, the speculation. Derivative notional amounts in the third quarter of 2022 was $195.1 trillion. $142 trillion are in interest rate derivatives. Now, remember, a derivative is just a big leveraged bet. It's not like they can convert anything into the underlying. So with most derivative contracts concentrated in interest rates, when the central bank was using their forward guidance to tell you, in other words, telling Wall Street, this is what we're going to do, so they could get into position to benefit from it. It hurts you, but it benefits them because it should be pretty clear that banks are too big to fail. You and I, we're the right sizes, but the banks are not. So 72.8 of total notional value derivatives are in interest rate related products. And we can see the battle on interest rates that are happening in the markets right now on what's happening with bonds. What's going to happen next? I don't know. We'll find out though, won't we? Because this gives you a relative image of the size of the real problem with derivatives. These are all derivatives. These are bank assets, a lot smaller than these two shores. And derivatives are big leverage bets that Warren Buffett called financial weapons of mass destruction. We've experienced that twice. 1998 with long-term capital management that was doing derivatives against government bonds, the safest things you can do. And it almost blew up the global system. We had to go in and bail them out, Wall Street and the banks, etc. So that you didn't even know that it happened. But I'm telling you right now, it absolutely did indeed happen. And again, in 2007 and 2008. So I really do, if you can look at it, you can see that, if these are assets and these are like football fields and tennis courts, etc., to give you an idea of the size, and then you look at, the derivatives, yeah, that can topple the system. And by the way, all of these derivatives have to shift by June 30th of this year. No one really knows the true value at risk because all of their accounting tricks, etc., actually hide it. And central banks, they're committed to raising rates and push the global economy into, Do you think this is going to be just not a big deal and short-lived? No. This is a very big deal, and central banks are most likely to be making huge policy mistakes because they're between a rock and a hard place. At this point, it really doesn't matter what they do. And even though they want us to believe, well, all central banks have to do is turn around and lower interest rates and start printing like crazy again, and we'll be out of a recession. Yeah, it doesn't really work quite that easy. If you like this clip and you want to watch the full video, just click right here. And to subscribe, click right here.